Hey there. So, this is Bob. Bob just got approved for a $200,000 mortgage. He walks out of the bank, opens his phone, and there it is, $200,000 sitting in his account. And Bob gets curious. He looks back at the building and thinks, wait a second, whose money is this? Did somebody's life savings just get handed to me? Did they take it out of a vault somewhere? The answer is none of that. That $200,000 did not exist 20 minutes ago. Nobody lost it. Nobody saved it up. A computer typed it into existence. And if that sounds like a conspiracy theory, here's the crazy part. It isn't one. The Bank of England published this in an official document in 2014. They even filmed a video explaining it inside their own gold vault, and almost nobody watched. So, what actually is money? Where does it really come from? Can banks just create infinite money? And most importantly, if almost all of it is only numbers on a screen, what happens if everyone tries to take it out at the same time? In this video, we'll cover everything you need to know about how money actually works. So let's get started. Section 1. What money actually is. Before we find out where money comes from, we need to know what money even is. There are 3 types, and you've only ever touched 2 of them. The first type is cash. Notes and coins. Made under government authority, and the profit from making it goes straight to the government. The second type is central bank reserves. Electronic money the central bank creates so banks can pay each other. And here's the thing, you can't have any, ever. Only commercial banks and a few big institutions have accounts there. Regular people aren't allowed in that room. The third type is the number in your banking app. And this is where it gets strange because this one isn't made by the government at all. It's made by private banks. And it is almost all the money that exists. How much is almost all? According to the Bank of England, 97% of the money in circulation is bank deposits. Only 3% is physical cash. So let that land. If all the money in your country were 100 loaves of bread, only 3 would be real bread baked by the government. The other 97 would be I owe us written by private companies, and everybody just agreed to treat them like bread. Try this. Open your banking app right now and look at the balance. That is not money sitting somewhere with your name on it. There is no shelf. There is no box. Legally, that number is only a record of how much the bank owes you. It's a promise. And a promise is only worth something if the other guy can keep it. Hold that thought. It comes back later, and it gets ugly. So now you know what money is. Your next question is probably, okay, but where does that 97% come from? Let's find out in the next section. Section 2. Where money actually comes from. Here's what school taught you. You put $100 in the bank. It keeps 10 and lends out 90. That 90 gets deposited. The bank keeps 9 and lends out 81. And on forever. This is called the money multiplier, and it's in almost every economics textbook on Earth. There's just one problem. It's wrong. And I'm not the one saying that. The Bank of England is. Banks do not act simply as intermediaries lending out the deposits savers place with them, and they do not multiply up central bank money into new loans. Their exact wording, money creation in practice, differs from some popular misconceptions. So what actually happens? Let's go back to Bob. The bank does not go and find $200,000. It opens a ledger and makes 2 entries at the exact same moment. On one side, a $200,000 loan. That's an asset the bank now owns because Bob owes it. On the other side, $200,000 in Bob's account. That's a liability because the bank now owes Bob. 2 numbers, 1 second. New money exists. The Bank of England even has a name for this. They call it fountain pen money, created at the stroke of a banker's pen when they approve a loan. Now you might be thinking, fine, but that's just theory. Has anyone actually proven it? Yes, somebody did. In 2014, a professor named Richard Werner did something nobody had done in the entire history of banking. He convinced a small German bank to let him take out a loan while he watched their internal accounting live. He borrowed 200,000 euros and just stared at the screens. What did he find? The bank didn't move money from another account. It didn't touch anyone's deposits. It didn't borrow from anywhere. It typed a new deposit into his account. His paper concluded that money is created as fairy dust, produced by banks out of thin air. And here's the part that breaks your brain. If loans create money, then paying loans back destroys it. The Bank of England says that too. Repayment of bank loans destroys money. So when you finally clear that credit card at the end of the month, you're not returning money to anybody. You're deleting it. It's gone. It never goes back into a vault because it was never in one. Which means something strange about your whole country. If almost all money is born from lending, then almost all of it exists because somebody is in debt. Pay off every loan on earth and there'd be almost nothing left. If that messes with your head, tell me in the comments. So banks create money by lending and destroy it when you repay. Which means your next question has to be, if they can type money into existence, why not type infinity? Let's talk about that in the next section. Section 3. So why don't banks create infinite money? Great question. And this is exactly where most videos on this topic fall apart into conspiracy nonsense. So let's be accurate. First, understand what the bank actually gets. When the bank creates Bob's $200,000, it doesn't go into the bank's pocket. It goes into Bob's. The bank's profit is the interest. So the bank isn't printing money for itself. It's printing money for you and then charging you rent on it, which honestly is a fantastic business. Second, there are real limits, 3 of them. Limit 1 is the bank itself. To make more loans, a bank usually has to cut its rates, which makes every loan less profitable. And the second Bob spends that money on a house, it goes to the seller, who probably banks somewhere else. The money leaves. Now Bob's bank has to settle up with that other bank using real reserves. Do that too often and you run dry. Creating money is free. Keeping it is not. Limit 2 is you. If people use that new money to pay off old debts, it evaporates again. Banks can create money. They can't force anyone to hold it. Limit 3 is risk. Every loan can default. The more a bank lends, the more danger it eats, and the more of its own capital it has to put behind that danger. And this is where almost everybody gets it backwards. Everyone talks about fractional reserve banking. 10% reserves, remember. Well, here's the thing. In the United States, the Federal Reserve cut reserve requirements to 0% on March 26, 2020. 0. It wiped out reserve requirements for every bank in the country, freeing up an estimated $200 billion. 6 years later, they still haven't brought it back. And the Bank of England? It has no formal reserve requirements at all, so the system you were taught to be suspicious of doesn't even exist anymore. What actually holds banks back today is capital, the bank's own money, at risk. Under the international rules known as Basel III, a bank has to back everything it lends with a slice of its own capital. In practice, big American banks hold 12 to 15%. Think of it like this. The old leash was, how much of other people's cash are you sitting on? The new one is, how much of your own money are you willing to lose? It's a better leash. It's still a leash. So now you know why banks can't print forever. But remember that promise I told you to hold on to? Here it comes. If 97% of money is only typed numbers, what happens when everybody wants it in cash at once? Let's find out in the next section. Section 4. What happens when everyone asks at once? Here's the honest answer. It doesn't work. It was never built to work. And you don't need a thought experiment here because it already happened 3 years ago in the middle of America. March 9th, 2023. Silicon Valley Bank, the 16th largest bank in the United States. In one single day, customers tried to pull out $42 billion, roughly a quarter of every deposit the bank was holding, gone before sundown. By the end of that day, the bank's cash balance was negative $958 million. Not low, negative. Why so fast? Because in 1930, a bank run meant standing in a line. In 2023, it meant a group chat. Investors posted warnings, founders panicked, and everybody hit transfer at the same moment. But here's the part that should really get your attention. Silicon Valley Bank was not a scam. It was doing the exact same thing every bank on earth does every day. And that thing is 400 years old. Picture a coat check. Everyone hands in a coat, gets a ticket, and the guy behind the counter notices that people never all come back at once. So he starts handing out extra tickets. And that's not a metaphor. That is literally how banking began. In 17th century London, after King Charles I seized the gold stored at the Royal Mint, people started leaving their gold with goldsmiths instead. The goldsmith handed them a receipt, and those receipts started circulating as money. They became the first banknotes. Then the goldsmiths worked something out. Since almost nobody came back for the actual metal, they could write more receipts than they had gold and lend those out at interest. It worked beautifully, as long as everyone believed. The moment they stopped, everybody rushed to redeem at once, and whoever was last in line got nothing. 400 years later, same trick, faster internet. So what protects you now? Deposit insurance. In the United States, $250,000 per depositor per bank. In Europe, 100,000 euros. But here's a number that never makes the news. As of March 2026, America's deposit insurance fund held about $157 billion. That works out to roughly 1.5 cents for every insured dollar, and the official target is only 2. Now, before you panic, since 1933, not one depositor in the United States has ever lost a cent of insured money. Not one. The system works. It just works the way a parachute works. Brilliant for one person. Catastrophic if everybody jumps together. And if you're above the limit, ask Cyprus. In 2013, Cypriot banks ran out of money, and for the first time in the Eurozone, depositors were forced to eat the losses. Anyone holding more than 100,000 euros at the Bank of Cyprus could lose as much as 60% of it. Around 8 billion euros of people's savings were simply shaved off. Legally. Okay, so money is made by private banks, it's almost entirely digital, and the whole thing runs on trust. Your last question is obvious. Shouldn't we just ban this? Let's find out in the final section. Section 5. So should we just stop banks from creating money? Well, somebody actually tried, and we know exactly how it went. In 2018, Switzerland held a national referendum on this exact question. It was called the Vollgeld, or Sovereign Money Initiative. The idea was simple: ban commercial banks from creating money, and make the central bank the only place it can come from. On June 10, 2018, the Swiss voted. Almost 76% said no. The head of the Swiss National Bank had called it an unnecessary and dangerous experiment that would badly damage the economy. So the most careful, most banking-obsessed country on the planet looked hard at the alternative and said, "We'll keep the weird system, thanks." Why? Because bank-created money isn't automatically bad. When a bank funds a factory or a new business, it creates money and creates real things at the same time. More money, more goods, prices stay sane. The real problem isn't that banks create money, it's where they point it. Look at the United Kingdom. Between 2014 and 2024, bank lending to real estate grew by almost 35%. Meanwhile, lending to every productive industry combined, factories, manufacturing, everything that makes actual things, grew just 6.5% in 10 years. Real estate companies now take 51% of all lending to small business, up from 39% a decade earlier. Do you see the problem? Go back to Bob. His bank created $200,000 out of nothing, but it didn't build a house. The house was already standing there. So now there's more money in the world and exactly the same number of houses. Now multiply Bob by 10 million people. You don't get a richer country, you get a more expensive one. That is a big part of why homes cost what they cost and why your salary never catches up. New money keeps getting invented and pointed at buildings that already exist. No new bread. Just a higher price for the same loaf. Which brings us back to inflation, and if you want that explained properly, I've got a whole video on it, link in the description. So, in conclusion, money isn't printed by a government in some big machine. It's typed into existence by private banks, one loan at a time, and quietly deleted when you pay it back. 97% of it has never been anything except a number on a screen. And none of it is hidden. Central banks published it. Nobody just bothered to tell you. And that's the real takeaway. Money isn't a thing you own. It's a promise somebody made, and the whole world runs on the fact that we all quietly agree never to check at the same time. Oh, and one more thing. Right now, private companies are issuing their own digital dollars. And one major bank chief executive has warned that as much as $6 trillion in deposits, about a third of all American bank deposits, could eventually move into them. Is that the end of banking? Well, that's for another video because we are out of time. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.